Welcome to another BAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over BAR Area 1. This is Section B2. This is an application topic. Determine the impact of changes in an entity's capital structure on cost of capital, loan covenants, liquidity, and leverage. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And after you watch that 1-hour webinar, you're going to want to learn more, so make sure you check out becoming a SuperfastCPA Pro member. Pro members get access to the full 10-question versions of these typically 5-question YouTube videos. So again, in today's video, we're only going over 5 questions, but SuperfastCPA Pro members will get access to the full 10-question video so that they can get a little bit more help and a little bit more understanding. If that is something that interests you or you like the other videos that you've seen from us, make sure you check out becoming a SuperfastCPA Pro member. Now with all that, let's dive straight into the questions. All right, here we are at question 1, and something I want to say, or a couple things I want to say before we dive in. First off, a lot of the stuff in this video is building off of or kind of related to what we talked about in the previous video where we talked about calculating the cost of capital. So if you haven't watched the previous video, this might be a little bit more difficult, so I would recommend maybe watching that video before you watch this one. But if you already understand how to calculate the cost of capital, then this video will be just as helpful. And then the second thing I want to say is one thing that I always like to point out is you want to read the last sentence of the question first. This is a great strategy for test day specifically because frequently if you read the last question or the last sentence of the question first, that will give you context for what the question is even about so that you know what you're looking for throughout the rest of the question. This is a very good habit to be in, so let's do that here. Assuming equity remains unchanged, what will be Grove's new debt to equity ratio and what does this indicate about the company's financial leverage? Okay, let's go up to the top. Grove Manufacturing has $300,000 in total equity and $200,000 in outstanding debt. The company plans to issue an additional $150,000 in long-term debt to fund expansion. So again, assuming that the equity doesn't change, what's the new debt to equity ratio and what does that mean about the company's leverage? So let's go through the options. Option A, the new debt to equity ratio is 0.67, and that means that the company's financial leverage has decreased. Option B, the debt to equity ratio has changed to 0.83, and that means that the company's financial leverage has remained stable. Option C, the debt to equity ratio has changed to 1.17, and that means the company's financial leverage has increased. And then option D, 1.5, the company's financial leverage has significantly decreased. So based on these different options and what it's asking, try to figure this out. You probably know how to do the debt to equity ratio. If not, that's okay. But I would recommend giving this a try. Maybe pause the video, think about this, and when you're ready, come back. We'll look at the answer together. All right, here we are at the answer C. It has changed to 1.17, and that means that the financial leverage has increased. So let's go through this. First off, the debt to equity ratio, again, it's very easy to calculate. You take total debt divided by total equity. So before they issue the new debt, it's $200,000 of debt divided by $300,000 of equity, giving you a 0.67 debt to equity ratio. After they issue the new $150,000 of debt, the debt is now $350,000 and the equity is still $300,000. So now the debt to equity ratio is 1.17. So there was a 0.5 increase in the debt to equity ratio. That means that Grove is now more financially leveraged, which basically means it's relying more on borrowed funds, the debt, relative to owner financing such as equity. So the higher or the more leveraged a company is, that means that they're taking on more and more debt compared to taking on more equity to be able to finance their expansions or their capital ventures. And higher leverage increases potential returns for shareholders, but also increases financial risk, especially during downturns, since more debt means more fixed interest obligations. So this is something that people want to pay attention to. They can take on more debt, but that does mean that they're going to be more leveraged if they're not also taking on more equity to be able to finance their projects. And if they're too highly leveraged, that can be bad because even though shareholders might get a higher return, it also increases financial risk, because there's more interest obligations and things are just riskier if you are more highly leveraged. So we learned a little bit about how changing the capital structure of the entity can change your liabilities and change the debt to equity. Now let's go to the next question. Okay, here we are at question 2. How would an increase in the corporate tax rate most likely affect a company's weighted average cost of capital, assuming all other factors remain constant? And remember, we talked about weighted average cost of capital a lot in the previous video, so if you haven't watched that one and you don't know how to do that, I would go watch that before you come to this. But let's go through the options. Option A, weighted average cost of capital would decrease because the after-tax cost of debt decreases. Option B, it would increase because the cost of debt rises. Option C, it would increase because equity becomes more expensive. Or option D, it would remain unchanged because taxes do not affect capital costs. Now, again, if you've watched the previous video, you'll have a little bit of an idea how the tax rate will affect the weighted average cost of capital. Now, if you don't know how to do this, that's okay. We are using these questions to learn, but if you remember anything from the previous video, try to figure this out, pause the video, and when you're ready, come back. We'll look at the answer together. All right, here we are at the answer A. Weighted average cost of capital would increase because the after-tax cost of debt decreases. So let's walk through this to show you what I'm talking about. Again, this is very related to what we learned in the previous video. Weighted average cost of capital incorporates the after-tax cost of debt because interest on debt is tax deductible. When the tax rate increases, the company receives a larger tax shield on its interest expense, which lowers the after-tax cost of debt and therefore reduces weighted average cost of capital, if you're not considering any other pieces of weighted average cost of capital. So let's go through an example to kind of show you what I mean. And again, this is a reminder of how to calculate the cost of equity. So let's assume that a company has 50% debt and 50% equity. That's their total capital. The cost of equity is 10%. The cost of debt is 6%. If the tax rate is 20%, the after-tax cost of debt is going to be 4.8%. And you do that by taking the previous cost of the debt, like the current cost of the debt, multiply it by 1 less the tax rate, and that gives you the after-tax cost of the debt. So the weighted average cost of capital is you take the 50% equity multiplied by 10%, which is the cost of the equity, and then you add the 50% debt multiplied by the after-tax cost of the 4.8% cost of debt, and that gives you 7.4%. So this is if the tax rate stayed at 20%. But if it increased to 35%, we do the same thing. We do the after-tax cost of debt, which is, again, the previous or the pre-tax cost of debt, 6% multiplied by 1 less the tax rate, which is now 0.35 instead of 0.2, and that gives us 3.9% of the after-tax cost of debt. So now we do the same weighted average cost of capital calculation, but now with a different percentage for the after-tax cost of debt, and that gets us a weighted average cost of capital of 6.95% instead of 7.4%. So the higher tax rate of 35% led to a lower weighted average cost of capital of 6.95% because it causes the after-tax cost of debt to be lower if the tax is higher. So make sure that that makes sense to you. Again, if the tax rate is higher, that means that weighted average cost of capital will be lower because the after-tax cost of debt will be lower. And if the tax is lower, then the weighted average cost of capital will be higher because the after-tax cost of debt is higher. And again, that is only based on if you're not including any changes in any of the other pieces of the weighted average cost of capital. A higher tax rate leads to a lower weighted average cost of capital, while a lower tax rate reduces the interest tax shield and increases weighted average cost of capital. That's something that I do think you'll need to know. So make sure you understand that. And when you're ready, let's go to the next question. All right, here we are at question 3. What is the company's new net after-tax cost of debt, and what does this change indicate about the impact of capital structure decisions? Let's go to the top. Leland Co. currently has a debt-to-equity ratio of 0.6 and borrows at a rate of 150 basis points over the 10-year Treasury yield, which is 4%. The company increases its leverage by issuing significant new debt, raising its debt-to-equity ratio to 1.2. As a result, lenders now demand 250 basis point spread over the 10-year Treasury. The corporate tax rate is 30%. So again, what is the company's new net after-tax cost of debt, and what does that change indicate about the impact of capital structure decisions? Now, if you have no idea what this is talking about, if I'm honest, I remember when I was learning about this, when I was doing the CPA, I had no idea what basis points were. So if you don't know what this is, that's okay. But if you want to think about this, we'll read through the options and then we can go to the answer together if you haven't already tried to do it on your own. So option A, 4.55%, and that's because the increased leverage raised after-tax cost of debt. Option B, 4.2%, increased leverage had no effect on the after-tax cost of debt. Option C, 3.85%, the cost of debt decreased despite more leverage. Or option D, 5.75% leverage eliminated the tax shield benefit. So again, if you have no idea what this is talking about, that's okay. That's totally understandable. But if you kind of have an idea of what this is talking about, or if you have seen this before in maybe the previous video where we talked a little bit about basis points, then try this on your own. And when you're ready, come back. We'll look at the answer together. All right, here we are. The answer is A, 4.55% and increased leverage raised at the after-tax cost of debt. So let's go through this to understand both pieces of that. First off, let's explain what basis points are. Basis points are used to express the spread above a benchmark rate. And simply, just so that you understand what a basis point is, 1 basis point is equal to 0.01%, or in other words, 0.0001. So 1 basis point is 0.0001. So if you have 150 basis points, then you would take 150 multiplied by 0.0001, and that gives you 1.5%. Or if you have 250 basis points, it's 2.5%. You can just see that you move the decimal over to the left twice, and that will give you the percentage. So now that we understand what basis points are, and now that we understand the percentages that come with those two different basis points numbers, 150 and 250, we can figure out the original pre-tax cost of the debt. When it comes to treasury percentages, you take the 4% treasury percent and you add the spread, So that's 1.5%. So if the basis points are at 150 basis points, you have a 5.5% of the original pre-tax cost of the debt. Now we can figure out the after-tax cost by doing, again, the pre-tax cost of 5.5% multiplied by 1 less 30, which is 1 less 0.3 or 30%, which is the tax rate. So that gives us 3.85% of after-tax cost with the original 150 points of basis. Now, when they issue more debt, they also get more leveraged, which causes the basis points to go up. So after the leverage increase, again, we take the 4%, which is still the normal treasury yield, plus the 2.5% that is now the basis points, and that's 6.5% pre-tax cost. So the after-tax cost is, again, the pre-tax cost of 6.5% multiplied by 1 less the 30% tax rate, and that gives us 4.55% of after-tax cost for the debt. So we can see here that by increasing the leverage, we also increase the basis points, which increase the cost of the debt. Because Leland took on significantly more debt, its debt-to-equity ratio doubled, increasing the risk to lenders. In response, lenders raised the required spread by 100 basis points, or 1%. Although debt remains tax-deductible, the higher borrowing cost from increased risk outweighs the tax benefit in this case, resulting in a higher net after-tax cost of debt from 3.85% to 4.55%. This illustrates how increasing financial leverage can actually increase the cost of capital if it pushes borrowing costs too high or pushes them higher. So again, even though they have more leverage, and that could be beneficial in some cases, because that happened, there's more risk, and so the lenders want a better spread or a bigger spread. So that means that the tax benefit that they originally had is starting to go away or is kind of being overshadowed by the extra basis cost or the extra cost that comes to their debt because of the spread going higher. So this is kind of an interesting question, and I think the thing I want you to most learn from this is what a basis point is and how to calculate the pre-tax cost of debt and the after-tax cost of debt when you have the basis point information. You need to know that you take the treasury percentage, add the basis percentage, and that gives you the pre-tax cost percentage, and then you can figure out the after-tax cost. That's the most important thing that I want you to learn from this question. So with all that, let's go to the next question. All right, here we are at question 4. By how much does the debt-to-equity ratio change after the new financing? Let's go up to the top. Riverside Inc. has total assets of $1 million and a debt-to-equity ratio of 0.5. The company raises an additional $200,000 in long-term debt and $100,000 in new equity. So again, how much does the debt-to-equity ratio change after the new financing? Does it increase by 0.1, 0.2, 0.25, or 0.33? Now, we've learned or we went over how to do the debt-to-equity ratio, and if you remember how to do normal accounting, you should be able to figure out this question. So pause the video, figure out the change in the debt-to-equity ratio, and come back when you're ready. Okay, here we are. The answer is B. It increases by 0.2. So the debt-to-equity ratio increases by 0.2. So let's go through this. First off, we have to figure out what the equity and liabilities are. We were only given the debt-to-equity ratio to start and the assets. But because of the accounting equation, we can figure out what that is. So the debt-to-equity ratio is 0.5, meaning if equity is X, then liabilities is 0.5X, or half of the equity. So to figure this out, we can take the total assets, which is $1 million, and that equals liabilities and equity is X and liabilities is 0.5X. So that means that 1.5X is equal to the assets, which is $1 million. So if we divide $1 million by 1.5, that means that X, which is equity, is $666,667. And then the remainder of the $1 million is the liabilities. So again, just by basic algebra, basic math, and knowing the accounting equation, we can figure out that based off of the debt to equity ratio and the assets, the equity is $666,667, and the liabilities are $333,333. Okay, so now that we know the original equity and the original liabilities, we can figure out what the new debt to equity ratio is when there's the new financing. So the debt is now the original $333,333 plus the new $200,000. So we have $533,333 of debt. Now, what about equity? Equity increases by $100,000, leaving us with $766,667 of equity. So now we can figure out the new debt to equity ratio, which is, again, the $533,333 divided by $766,667. And that comes out to like 0.695 or 0.696, somewhere around there. And so we round that up to 0.7 for this question specifically. And we can see that the original debt to equity ratio is 0.5. The change was from 0.5 to 0.7. So there was an increase in the debt to equity ratio of 0.2. This question shows how changes in capital structure, as in when debt and equity both increase, those both changed, you can still have the debt to equity ratio go up if debt increases proportionally more, increasing financial leverage. And it did increase proportionally more because there was less debt to begin with, and it had a bigger jump of $200,000. So that meant that the debt to equity ratio went up, even though both equity and debt went up. So that one was a pretty simple question when you just think about calculating debt to equity ratio, which is a pretty simple calculation. So with that, let's go to the next question. All right, here we are at question 5. What is the most likely effect of this change in capital structure? Let's go to the top. Timberline Co. recently issued $500,000 in new short-term debt to fund operations, increasing its current liabilities without a corresponding increase in current assets. As a result, its current ratio fell from 1.8 to 1.2. Timberline's loan agreement requires it to maintain a current ratio of at least 1.5. So what is the most likely effect of this change in the capital structure? Option A, improved liquidity and strengthened covenant compliance. Option B, higher profitability due to increased operating leverage. Option C, no effect on liquidity or covenant compliance since assets remain unchanged. Option D, reduced liquidity and potential loan covenant violation. Okay, so again, what is happening here if they got $500,000 of new short-term debt to fund their operations, which increased their current liabilities without increasing their current assets? And don't think too much about that. It probably normally would just increase cash, but it's saying here that it didn't increase current assets somehow, so that's what we're going to go with the question. So again, what is the most likely effect of this change in capital structure? What does this cause to happen? So pause the video, think about this if you want, and when you're ready, come back. We'll look at the answer together. All right, here we are. The answer is D, reduced liquidity and potential loan covenant violation. So that's what's happening here. By issuing short-term debt without increasing current assets, which again, typically that doesn't happen, but we're going to assume that that was possible in this case, Timberline increased its current liabilities, which directly reduced its current ratio from 1.8 to 1.2. The current ratio, current assets divided by current liabilities, is a common measure of liquidity, and a drop like this indicates reduced ability to cover short-term obligations. And that's what liquidity means, that in the short term, you can have liquid assets like cash or sometimes even receivables that can be used as money to meet your short-term obligations like interest and such. Because the company's loan agreement requires a minimum current ratio of 1.5, falling to 1.2 means Timberline is now out of compliance with its loan covenant. Violating covenants can trigger penalties, increase interest rates, or allow lenders to demand repayment. This question demonstrates how a capital structure decision, which was specifically about increasing short-term debt, can negatively affect liquidity and breach loan agreements, increasing financial risk even if total assets remain constant. And so again, the idea behind this question was to remind you about liquidity and loan covenants. Changing your capital structure can have a positive or negative effect on liquidity, and you need to pay attention to loan covenants when it comes to changing the capital structure of your business. So with that, we learned a lot in just 5 questions. Now, before we do anything else, let's do one more part of the SuperFast CPA process called Pillar Topics. Now, the idea behind Pillar Topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you about maybe something like the tax rate affecting the weighted average cost of capital or something like that. So again, you notice these things as you're going through the questions, and you take a moment and write them out in your own words as the pillar topics based on what you learned. And as you're doing this each day, you are building your own personal repository of the most important things you learned from the questions in your review course so that you have it written out and you know what is important for the exam when you get to test day. So let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. Increasing debt without increasing equity raises the debt to equity ratio, increasing financial leverage, which amplifies both returns and financial risk, which can have its own effects. Now let's move on to the next one. A higher corporate tax rate lowers the weighted average cost of capital by increasing the tax shield on interest expense, while a lower tax rate has the opposite effect. When a company increases leverage, lenders often raise the interest rate spread, or raise the basis points over the risk-free rate, which increases the after-tax cost of debt potentially. So, it might have a different effect than what you're planning. If debt grows more than equity, the debt-to-equity ratio increases even if both components rise, resulting in higher financial leverage. And what it's trying to say there is if debt proportionally rises more than equity rises proportionally compared to what it was previously, then that means that the debt-to-equity ratio will be higher, meaning that there's more financial leverage, even if equity is still higher than debt. But if debt got a bigger increase than the equity, then again, that will mean more leverage. And then finally, taking on short-term debt without increasing current assets, which typically doesn't happen, but again, just pointing that out, it would weaken liquidity and can cause a company to violate loan covenants based on current ratio requirements. That last pillar topic is a little bit less important than the other ones, so that's why it's the last one, but still something that you might want to think about. Again, the main idea behind all of that in this blueprint topic is that you want to think about liquidity and think about loan covenants when you are changing the capital structure of a company. So with that, we learned a lot again in the first 5 questions and the pillar topics for this video. And remember, that is the end of the YouTube version of this video. We only did 5 questions, but if you want to become a Superfast CPA Pro member, you'll get access to the full 10-question version of the video so that you can get a little bit more help and a little bit more understanding. So if you like this and you like our other products, make sure you check out becoming a Superfast CPA Pro member. And the easiest way to learn about and become a Superfast CPA Pro member is actually by going to SuperfastCPA.com and first watching our Superfast CPA training webinar, where in 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And then again, after you watch that 1 hour webinar, you'll have a better path to learning about and becoming a Superfast CPA Pro member. So check out the webinar, then check out becoming a pro member. Now, if you liked this video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.